Greetings, my beloved clients and friends. So we've been in a period of a market pullback for the last couple months, and so I wanted to give another update because and answer this question: Is this pullback a temporary setback, or is it the end of the era? Okay, because depending on which one we believe it to be, our reaction would be different. If it's just a temporary pullback, then we'll just navigate through it. But if it's the end of an era, then we'd make more dramatic changes. Okay, so I believe it's just a temporary pullback, and I'm going to give you one reason, well, two reasons why I think that's the case. Okay, so by the way, I'm in my office because I was going to record this morning on my hike, but it was a little windy and I haven't figured out how to get rid of the wind noise. So anyway, if you look at the market over a long period of time, like over the last 100 years, there's a couple trends, and one trend is that over time it's basically done nothing but go up. But the other trend is that it has these periods when it's going up, and then like a period of a extended period of you can call it a pullback or a less productive market, and it's kind of like two steps forward and one step back. And if you look back, the 10s and 20s of the last century were really good, especially the roaring 2000s. I mean, the roaring 20s, that's what they called it, the roaring 20s, right? And very good markets. And then we got the big crash and of 29. And then there was a period, the 30s, and really until World War II, the markets were just not good. People got just a general distaste for the markets, and for that 15-year period, markets weren't good. But then we got through World War II, and really into towards the end of World War II, the market started picking up, and then the market started doing better, and especially the 50s and 60s were a really good time in the markets. So like 2 decades of really good returns. And then market peaked around 1970 and had a decade where it just really wasn't that good. So it was like 2 good decades, 1 not so good decade. Then we got into the 80s, and the 80s and 90s were very good. 2 good decades. And then the 2000s was often called the lost decade because it wasn't just a very good time to be investing. Okay, so now we're into the and which ended about 2009, and then most recently we've had about a 12-year run. So I want to look at that pattern. A couple good decades, and then the market gets like way overvalued, and everyone's in it, and that's what people talk about, and that's the in thing to be doing. And then it just gets so overvalued that there's this massive correction, and it's a long-term pullback when it's not a good time to be in the market. And then it gets so cheap because people get basically so disinterested in it. And then it paves the way for another long run, ending in overvaluation and everyone in it, and then a big pullback, right? So that's the pattern. And so if you look at the tops, there was a top around 1930, actually 1929, but right around 1930. There was another top around 1970, 40 years later, and then there was another top around 2000. Okay, and each of those tops were followed by a decade of just not a good time to be in the market. And so the question is that what we're looking at right now, or is this just a pullback in the middle of a couple decade run? Okay, so because during those good times, even during the good times, the 50s and 60s, for example, was a very good time. The 80s and 90s was a very good time. And the last 12 years have been a good time. Even in those good times, there have been pullbacks. There have been many, many corrections. I think about 70 of them since World War II, I believe. 70 pullbacks, corrections of 10% or more, and many bear markets defined as a pullback of 20% or more. And even in this most recent pullback, in the first quarter of 2020, we had like a 25% pullback. In the end of 2018, we had a 20% pullback. And even with that, our portfolios have done very well. Over a 5-year period, we've been averaging close to 25%. And that's throwing in these occasional 25% pullbacks that we just navigate through. Okay, so again, is this just one of those pullbacks that we just got to grit our teeth and navigate through and we'll come out better in the end? Or is it the end of an era? Okay, so here's an interesting thing that correlated with those big run-ups were some demographic trends. Like they coordinated with these three big generations, and you could call them the so-called greatest generation, the generation that won World War II, the baby boomer generation, those born after World War II, and then the millennial generation, right? So, and if you notice, around the time that the meat of that generation turns around 30, it really corresponds very closely to the start of these 20-year pullbacks. And then when the meat of that generation turns about 50, it corresponds with the tops of those pullbacks. So those the greatest generation was born in the 20s and 30s. So right around 1950, they were about 30, right? That age range. And about 1970, they were about 50. Okay, they were born in the 20s. Because when World War II started at around 1940, and they were all signing up, they were late teenagers, or that age range, So basically, they were born in the 20s, early 20s, right? So for that run in the market from 1950 to 1970 coincides really closely with that greatest generation being in their 30s and 40s. Okay, and then if you look at the good times in the market in the 80s and 90s, it corresponds very closely with that baby boom generation being in their 30s and 40s, because that baby boom generation was born after World War II. So if they were born around 1950, around 1980, they were 30. Around 2000, they were 50, right? And then this most recent one corresponds very closely. It started around the time that the millennials started turning about 30, and millennials aren't going to turn 50 for another 10 years, right? The front end of the millennial generation is around 40. Okay, and so if we've talked about this in other videos, when people are in their 30s and 40s, really when they're younger, in their 20s, they're real optimistic and excited about maybe what the world can be, and they want to go out and change the world, right? And make it in their image, and they want to fix the wrongs of their parents' generation as they perceive them. And but they don't have any economic capital in their 20s. By the time they start getting into their 30s, they've been in the marketplace, they have some experience, and they're starting to work their way up into leadership positions, and they're starting to become the entrepreneurs that are doing exciting things, and they're wanting to change the world for the better as they perceive it, right? So if you think about the millennial generation, what are their big hot button issues? They're really big into the environment, right? We want to secure the environment for our generation and for our kids, and we're not so big into fossil fuels and those type of thing, right? So the millennials, they're big into electric vehicles, for example, because of their concern about the environment, and they have concern about human rights and things like that, and rights for minorities by race and nationality and by sexual orientation. We want equal rights for them, women, and so they want to make those kind of changes, right? And they want to use the newest technology as well. All three generations, the greatest generation, there was racial atrocities from the Nazis towards the Jews, and they wanted to liberate the world from that. And the baby boomer generation, they wanted civil rights and women's rights, and they fought for that. And millennials are on those same hot button topics, So, and they're willing to try new things, and they do things different than the previous generation, and those companies that cater to those new things of that generation tend to do really well, right? And so there's this period of change, innovation, new leaders in the markets, and that lasts that generation is in their 30s and 40s, right? And then by the time that generation gets to their 50s, hopefully they've accomplished the things that they wanted to accomplish, and they've made the world, in their mind, a better place. And now they don't want it to change, because now they like the way it is, because it's the way they wanted it to be, right? So then in their 50s and stuff, they're like, okay, keep the world the way it is, the way we made it. Until the next generation says, we want to fix your problems, right? So the time that the market really responds well is when that generation is in their 30s and 40s. And then they go into status quo mode, and then the market, goes through, a 10-year period where it's unexciting, until the next generation rises up and changes things, and gets change going, and movement happening, right? So I guess that's one reason why I believe that, because the millennials haven't hit their 50s yet. They still got a lot of things they want to accomplish. They want, Tesla, that Elon Musk is their guy, and he wants to accelerate the world's transition to sustainable energy, and he still needs probably another decade for EVs to become the norm, and so, the other thing that the millennials want to do is take the power out of the hands of governments and banks in terms of money, right? So they're into cryptocurrency, and that's starting to happen, but it's going to be another decade, of that type of change. And so I think there's still a lot of and their environmental issues. I think there's still another decade of them wanting to change the world and getting it to where they feel, okay, this is our world now, and we like it the way it is, right? So that desire for change is gonna, I think, means that this pullback is a temporary pullback. Now, so if you look at those previous runs, the 80s and 90s, there were big. There was one, 1987, Black Monday, right? When market was down like 26% in one day. But what should have been the response to something like that? The best thing would have been to do is just navigate through it, because going into that, it was a really good year, and then there was this terrible one day, and then some choppiness, and then the market kept going for another 13 years. So no one could have really, I don't say no one, but it would have been very difficult to get out before that and then get back in to avoid that, right? Because it was such a short-term drop. And even if you would have said, man, I see this coming, I feel it coming, and you pulled out like a month or two too early, you missed a big run up. And then if you said like, okay, I feel like it's over, I'm gonna get back in, but you were a month to too late, you missed a big part of the bounce, and you didn't really make any money besides create all kinds of taxable gains for yourself. So it was such a short-term thing that there's no real way to get out before and get out back in after, and that would make sense. The best thing is just to navigate through it and hold on. That's different from 2000, when it was the end of an era, and then you got into a period where it was just a decade that wasn't good. When in that type of market, then it's time to say, okay, let's shift. And at the time, you could get 6% bonds in 2000. At the time, real estate was just starting to have a good 7-year run, and so you'd make some dramatic shifts. So I don't think we're in that type of market. I think because of where we are in the demographic cycle, this is another one that we just navigate through. Like my clients let me navigate through 18, fourth quarter, and first quarter 2020, and we did just fine. So, and we're making adjustments, and we're seeing that there is some areas of the market that are really had gotten really overvalued, and so we're trimming those positions dramatically and shifting to more value ones. So I think that when this pullback ends, we'll be well positioned to have another decent year, 22. So those are our thoughts on why I believe that we should just navigate through this one. And so if you say, well, Jonathan, what are the odds that this is just a temporary pullback versus an end of an era? And I would say probably 60-40, 65-35. I'm not saying 100%, and we cannot be at the end of an era, but I think the odds, if I were to be a betting man and place odds, I'd say probably about 65% that it's just a pullback, 35% that it's the end of an era. Because quite frankly, to be honest, there are some similarities in this market to the 2000 pullback. The most speculative stuff ran up quite a bit, and it gave back, and it started to give back a lot. Like even though they're saying I think right now the S&P is 7 or 8% off their high, and the NASDAQ is I think close to 15% off their high. There's the more growthy side. A lot of those companies are 50, 60, 70% off their highs. Okay, and so like in the late 90s, these .com stocks had gone way up, and a lot of those came way down, like 80, 90%. There was a fund that was the poster child called Munder Net Net, And that thing had done 70-80% returns for a mutual fund, because it was all those those internet stocks, right? And that thing just was obliterated in 2000. I think it was down like 80%, right? And so there's a famous portfolio manager named Kathy Wood, and she was just the poster child of that high future growth type of company, and these innovative companies of the future that over the next 10 years are going to do great things, right? But right now are losing money. And those companies, she was up like 150% in 2000. And since about March, she's down like 50%, right? And the companies that she's in. So she's like the Munder net of her generation. And so that's similar to 2000. And yet the difference is we're right in the middle of the innovative period of a generation's life, meaning the baby boomers. And we're not in the same interest rate environment as 2000. In 2000, if you wanted to be out of stocks, real estate was really cheap and bonds were really good. So you had two other attractive options. Right now, real estate isn't cheap. It's participating in the run too. So it's not like, okay, money's going to say, well, let's go to real estate because it's really cheap. It's had a nice run too. Or let's go to bonds because, we at least get a safe 6%. That's not the case. Long-term bonds are 1.8%, and the Fed's talking about raising, 6 interest rate hikes over the next 2 years. So bonds are not attractive alternative, and real estate, I'm not saying it's not an attractive alternative. I think it is, but it's not super as cheap as it looked in 2000, right? So I think the odds are better that we're just in a pullback. So that's how we're gonna react. We're gonna watch it closely. So we're making changes. We're navigating through it as if it's a temporary pullback. We're raising cash. We're getting rid of the highest flyers, but we're not just all out. And the stock party's over. I don't think so. There's still too many exciting things that are on the horizon. Tesla's just getting going, and the metaverse and cryptocurrencies, and 5G is just coming out, and so there's still a lot of exciting opportunities. And I'm not saying we're going to invest directly in those type of things. That's what's the portfolio is going to built upon. But I think there's still opportunity. So I kind of went a little long-winded, but I think it's important. Clients want to hear what we're thinking and what we're doing right now. Okay, so have a good weekend.